the next session now. And may I request Mr. Raj Pai, Managing Director, Global Environmental Fund, Advisors India, to please join me on the dais. Nishchal Joshipura, he is a partner and head of private equity M&A. Rajesh Simhan, please come, Raj. It's okay, no formality. Rajesh, head of international tax, and Richie Sancheti, head of our funds formation practice. So because the first point in life cycle is giving birth, so giving birth to a fund is fund formation, and there are a number of issues around that. So, thank you. Before I start, just to walk you through some material that is in front of you. We have, first of all, doing business in India, and then there is a book on fund structuring and operations. It contains global regulatory tax development impacting India, focus funds. Then private equity and private debt investment in India, private equity and debt in real estate. So all these books are primarily on the fund investment, stuff like that. So what we would like to do in the time that is available with us is about 50 minutes. 35 minutes we'll spend on some interactive discussion, and then we would like to open the floor for questions and answers. We'll first take questions from those who are present here, then possibly some questions from people who are on the phone. A large number of people also from around the world, including from India. I do not know at this point in time. People are so interested. There are people from India who have also registered to attend this conference via phone, audio conference. So I think that's the way. And then if you have any question otherwise, you can also send an email on fundsteam@nishithdesai.com. If you see first page, the program is in this booklet. And I suggest you can flash your questions at any time. And if you have time, we'll take those questions. If we do not have, then we'll respond at a little later stage, and we'll catch up with you. So let's start off. Let me ask Raj Pai, what do you see the current environment for raising commitments for India Focus Fund? How is the interest, and what do you see around?
Okay. Thanks, Mr. Desai. So GEF is a private equity firm, and as the name suggests, so we invest primarily in the environmental and natural resource efficiency sectors. So just to answer the question, if I can just give a context of what the environment was when we raised the India Fund in 2009, and that kind of use that as a context to quickly answer this question. So when we raised the fund in 2009, and I think Nishith Desai and team was, you guys helped on the legal side of the fund. So it was a different story then. 2009, I think the GDP was, we sold a GDP, a 9% GDP story at that point. Rupee was at around 45. So kind of in the last 4 to 5 years, if I can just reflect, the rupee, of course, has depreciated more than 30%, and the GDP story now is about 50% of what it was. So I think, it's been a tough 4 or 5 years in India. Just to kind of add on to the challenges, I think we'll hear a lot about some of the tax uncertainty and all of that, which did concern a lot of new money coming in. For those who are investors, LPs in the room here, exits were one of the concern that, I talked to a lot of my friends who are LPs, they were comparing the exits they were getting from India fund versus the other funds, and they were not too happy with the pace of liquidity. So there were a lot of challenges, I would say, in terms of a lot of these macro and also India-specific issues. So with that, I would say the current environment, I'm very optimistic. We are actually gearing up. So when we launched the fund in 2009, 2010, we were very fortunate because we got a different kind of investor set. Some of our investors tend to be what I call developmental institutions. So IFC, Asian Development Bank, Japan Bank and OPEC, a lot of these financial multilaterals. So that actually helped because, once you have a little bit of a differentiated strategy, that helps a lot. But I think the current environment, if I can answer, is, it's kind of mixed, but more on the positive side. I think we are just in the last 3, and Mr. Mule mentioned, and I firmly agree, and I'm excited about the sectors he mentioned, because those are the core sectors we are looking at, the smart cities, the sanitation, which is waste management, and all of the, this is where I believe a lot of the new investor interest will flow in. So a couple of things. One is, we as GEF, also globally, GEF invests across multiple emerging markets. So if you look at the BRICS lens, for example, I think with the exception of maybe the R, I think there's some geopolitical concern there. India still looks very attractive compared to the other 4 countries in the BRICS bracket today, more so than it looked for 4 or 5 years ago, for good reason. So I think that's a good, for an investor, you always get compared into the peer set. The second, I would say, definitely there is some, positive sentiment, good stability on the economic and on the political stability. And I think there is a lot of expectation that the policies of this government will be, see, the worst thing that investors get concerned and nervous about is the uncertainty. It's not, the good news is good, bad news is understandable, but not knowing where things will end up is probably the worst of the lot. So with that outlook, I feel the current environment for raising India-specific funds remains very positive, and is more focused on 2 aspects. The funds who have a good track record, I think will find it easy to raise new funds, but also funds who have a slightly differentiated strategy, will also, will get more interest. One example is like, one of our friends in the Special Situations Fund. They raised one of the largest fund last year in India, and I think it was well oversubscribed, even though it being the first fund in that vintage, So I think if you're differentiated and if you have a good track record, I think this is one of the best times. Can't be any worse, let me say that.
Excellent. But now that you have made all this comment, I would also like to tell you that after we finish basic panel discussion, feel free to give your comments or questions. So it's not only the questions, but you can also comment. If you see anything else, please feel free to react on that. But let's move on. And Richie, what are the structuring elements you see in a fund? Are there some new emerging standards in India? Because traditionally we worked in a particular way. We had our own way of doing things. Now we have learned a lot of lessons. But has there been some improvement in the standards, the way in which people think and do their fund formation?
No, so just carrying on cue from where Raj left off, Raj indicated that there has been renewed interest on the LP front. So a GP pretty much on the road today can expect a lot of excitement from the LP base. We have seen a lot of existing funds who had achieved a first closing but were struggling with a final close. They are pretty much getting more traction from the LPs as opposed to first-time GPs or GP trying to set up after they've run out of their dry powder or their successor fund limitations are over. Clearly, the advantages with the GP who has a fund on the road. As far as you look at Indian, focused funds, etc., or funds with India allocations, there are pretty much 3 buckets that we can talk about. The first one is a global sort of a mandate GP, or those who have a Asia-Pacific sort of a allocation. There, India also figures, owing to some of the issues that were hampering the Indian industry. The Indian ticket size or the allocation has been shrinking, but they are pretty much there on the road. Another is a class of rupee-denominated funds in India. I'm sure you are aware there has been a sudden explosion of HNIs, etc. in India, and the placement agents have been very active on raising commitments for rupee-denominated products. The third bucket where we saw a lot of tension and a lot of firefighting for the GP to do was setting up an offshore fund with an India focus. So pretty much the story being sold was India. The GP may have some asset class focus, etc., which make their story compelling. But they are the ones who are fighting the demons of retrospective changes, GAR, policy shifts, etc. So pretty much the good news there was like none of the LPs were complaining that the fund documents were not right or the fund terms were not right. Clearly the fund councils have been doing their part, but clearly the mood was sober. So what we have seen so far is, as far as GPs who have been successful are GPs who have a track record, like Raj indicated, a Series 2, Series 3 fund succeeding if the GP maintains the discipline, without maintaining the style consistency, like not being an investment strategy drift. Number one, you focus on the same deal ticket size, the same number of deals, pretty much keeping your corpus intact. That is where you have developed a track record. So a $300 million fund suddenly moving to a $450 million bracket may not, sort of get to rely on their track record. So what also is a track record which LPs, appreciate is a term which has to be appreciated by the GPs. You can't suddenly just go ambitious just because your last fund did good or, you are exiting all your portfolios. If you talk about, fund structuring, pretty much the focus is which is the jurisdiction that you will be pooling your fund. Now, as a jurisdiction and as a pooling vehicle to begin with, there are two very critical tax aspects that you talk about. First is neutrality and second is certainty. When we say neutrality, what we mean is that the structure should be neutral. Investors should not be worse off had he invested directly at the assets. So the fund pooling vehicle should be a sort of a tax pass-through. Second element is uncertainty. You should know at each layer what the tax element would be. When you're upstreaming cash flows from your portfolio to the fund, number one, or number two, when the fund in turn is doing distributions to the LP, there should be complete certainty. That is where treaties afford you some amount of certainty as opposed to relying on the Indian Finance Act, the Local Income Tax Act, which is susceptible to changes and pretty much retrospective changes on a year-on-year basis. My colleague Rajesh will be dealing with that issue. The second issue with a pooling vehicle is also, the marketability to the investors. If you are setting up funds for, let's say, tax-exempt, taxable, non-US investors, or you are, sort of marketing it to European LPs, then you not only have to be aware of the placement regime, like Alternate Investment Fund Managers Directive, AFMD, which some European nations have adopted, some have not. UK clearly adopting, a phase one, etc. Even US, whether can someone do a reverse solicitation? What are the exemption limits under the Investment Advisors Act, the Investment Companies Act, the 3C1, 3C7 rules, etc. All those things have to be mindful of when you are choosing the right structure, the approach of the advisor to sort of liaison with the distributors, etc., how the product is sold. We pretty much have cases in our hand recently where a lot of 2006-07 vintage funds who are still struggling because of the rupee not doing good. A lot of LPs have been sort of raising issues that, okay, was the product missold? Was the India risk factor not adequately highlighted? So those are the things, when you choose a jurisdiction, some of the placement rules, are there any existing standards already there? You have to be mindful of. The next structuring issue is on the management side. Clearly, LPs would want the management team closest to the assets. But because of permanent establishment challenges, etc., it may not always be, it might even, in fact, be counterproductive for the fund, that if the management team is based off India, would they be, have constituted a permanent establishment? So that is another factor that, you take into account. Apart from the pooling vehicle where the LPs participate, the management structure, a third very critical, structuring program is on the carried interest. Especially after the ILPA version 2 came out, there has been a lot of clamoring by the LP community that, okay, what is the split of carry between the team and the institution? Because a lot of Indian GPs are institution backed, etc. So is the team motivated enough? Is there something within the carry structure which prevents the churn in the team? Because a lot of there has been a consolidation in the Indian GP front, etc. So this, I thought, were some of the major themes when you are talking about funds. My colleague Nishchal will later on be talking about rupee-denominated funds. Now, Indian securities regulator, SEBI, has also been coming out with a lot of innovative products, which is meant more for consumption by Indian investors. Foreign investors are also welcome. A lot of recent structures allow foreign participants. A lot of certainty within the Tax Act, and the treaty also is there. So that, I thought, is a brief summary of where the Indian fund industry is currently and what the GPs are looking at.
Thank you so much for elaborate explanation on the whole structuring part. But Nishchal, you might want to add something on what are the structures for pulling India-based vehicles for domestic and offshore LPs. You can just take in.
Sure. So traditionally,
including REITs, if you take a word or two. That
sure. So traditionally, out of the total private equity investments which have happened in India, almost 80% has come from foreign LPs and 20% has come from Indian LPs. So foreign capital is extremely important for the development of the private equity industry in India. Now, as Richie mentioned, typically we have seen three structures for investing into India. The first one being the global fund where there is an India allocation. And typically you will have a blocker Cayman Corporation for US tax-exempt investors and Delaware LP for taxable investors. And the Delaware and the Cayman feeders will feed into a Mauritius master, and Mauritius master will invest into India. So that's one structure which is used. Second structure which is used is where you have the Mauritius entity as a pooling vehicle where all the investors come in and then they invest through the Mauritius vehicle in India. And the third structure, which is more of structure for raising funds from Indian LPs, is what we call a domestic trust structure. So interestingly, like in the US, limited partnership is the most common form of entity for setting up of funds. When it comes to India, the trust is the most preferred vehicle for setting up a fund entity. Similarly, because US India or Cayman India, US India does not have a good tax treaty as far as capital gains is concerned, and Cayman India did not have a tax treaty. So typically what is done is the investment is routed through one of the preferred jurisdictions in India, either in the form of Mauritius, Singapore, or Netherlands. And Rajesh will deal more with the tax issues surrounding each of these jurisdictions. But what is important to know is when you are investing into India, it's always good to invest through a corporate structure. Because of the tax treaty issues, the Indian government could challenge the availability of tax treaty benefits if the investor in India is a non-corporate entity. So that's something that has to be kept in mind when you are investing into India. The other important, the couple of other structures which have come up is, actually the private equity boom started in somewhere in 2005-06 in India, when a lot of funds were set up and they started investing in India. So 2006 to 2008-09 was what many people say was the era of blind investing in India, where everybody signed term sheets and closed the transactions in no time. The diligence was not up to mark, and a lot of funds were raised. Even the first-time fund managers were able to raise funds, which has completely changed. And as Raj mentioned, average life for raising a fund, average tenure for raising a fund was 9 months in 2009, which increased to almost 18 months in 2013-14. So a lot has changed from 2009 to 2014, and so has the product which has been offered by the fund change. So earlier we saw a lot of equity fund structures for investing into India, but over a period of time, the LPs started getting concerned about the money not being returned back from India. And that's where the debt structures started working for raising offshore funds. And since 2010-11, we saw a lot of debt funds being raised outside India, because on debt you can get regular coupons. And that was very comforting to the LPs, because every year they could see some form of coupon coming in or coming back to them, rather than they waiting for 7 to 10 years to see the dollar which they had invested coming back to them. So depending again on whether it's an equity structure or a debt fund structure, there are a lot of considerations which change, including the jurisdiction which you use for investing into India. And I think the most important consideration which we have seen when it comes to raising funds by Indian GPs. So when an Indian GP is raising both an offshore fund and a domestic fund, so you're raising money both from offshore LPs and domestic LPs, what is important to understand is that because of exchange control regulations in India, typically we always have a domestic fund raising money from domestic LPs, and you always set up an offshore fund for raising money from offshore LPs. And there the question which comes up is, what type of structure should be used if you are raising both an offshore and a domestic fund? There are typically two structures which are used. One, what we call the unified structure, which is a master feeder structure, which all of you are aware about, where let's say a Mauritius fund is raised from offshore LPs and you have an Indian fund raised from Indian LPs. The Mauritius fund feeds into the Indian fund, and then the Indian fund invests into the portfolio companies in India. As compared to that, the other structure which is there is where there is a co-investment which happens from the Mauritius fund and the Indian fund directly into the portfolio company at a certain pre-agreed ratio. So what drives the choice of whether one should go for a unified structure or a co-investment structure, a lot depends on where your team is based. So for an Indian GP who only has team in India, a unified structure does make sense from a permanent establishment perspective, because for them to have a team outside India or to get their carry and management fee outside India, it becomes a bit of a challenge because of the Indian exchange control restrictions. But at the same time, a unified structure also has certain tax complications in India, because like in the US, the Indian trust structures are not completely pass-through, as in the law does not provide a clear pass-through to the Indian trust structures, although there are sections under which you can claim benefit of a pass-through. But that's also something which is, you have to ensure that your documentation is in proper shape to ensure that there is a complete pass-through at the India level. As against that, in a co-investment structure, there is much more flexibility where your offshore fund can directly invest and your Indian fund can directly invest in the portfolio companies. And the tax issues are also, to that extent, much lesser in a co-investment structure as compared to a unified structure. But it is important in a co-investment structure that you also have a team outside India who can manage the offshore fund. This becomes important from a tax perspective because, as some of you might know, India is going to introduce general anti-avoidance rules from 1st of April 2015, where the substance of the transaction or the substance of the structure is going to be very important. Traditionally, India has always followed form over substance, but through GAR, India is moving from form over substance to substance over form. So it becomes very important that all the fund structures which are set up now the documents are very well drafted to ensure that for each and every part of the structure, whether it's a carried interest structure or management structure or the fund structure, the documents are thoroughly drafted to ensure that for each and every clause or each and every arrangement which the GP has with the LP or with the manager, there is a clear commercial justification which is provided in the documentation. So broadly, these are the structures which are prevalent in India, and that's how the investments have been made by the foreign LPs and the Indian LPs in India.
Oh, thank you so much. One thing you noticed that has happened in India over a period of recent years is that change of the government attitude towards foreign debt. Traditionally, we never liked foreign debt, but suddenly you see there has been some change and it is welcoming debt now. So the debt market has not been up to the speed in India, and I think that's what everybody is looking at. So I think that is one interesting thing I found what you spoke about. And but next point is on the tax in particular. Rajesh, can you tell us what are the considerations determining fund jurisdiction? That question keeps on coming up all the time. What are your views on investing through Mauritius, Singapore, and Netherlands? Has the budget 2014 made any change to this analysis? I think all three questions is one.
I think the good starting point for that is what Raj mentioned, the fact that what investors are really looking for is certainty. And traditionally, when you looked at India-based funds, a lot of them were really either they were having the master fund in Cayman and then using SPVs for investment into India through Mauritius, or you had the fund itself being set up in Mauritius for investment into India. The big issue that came about a few years back was really that the government was relooking at the Mauritius treaty. Questions arose as to whether the Mauritian treaty benefit would continue. And the government also introduced the general anti-avoidance rules. And a lot of issues were being raised, or concerns were raised, as to whether or not the treaty benefit which a Mauritian investor enjoys, in the sense that any capital gains which are earned by a Mauritian company from sale of shares of an Indian company is not taxed in India. And it's effectively going to be taxed only in Mauritius. And Mauritius, of course, doesn't tax capital gains. So the big question that was always there was, will investors be entitled to the treaty benefit and because of the introduction of the general anti-avoidance rules. The second issue that was there was in respect of a lot of portfolio investors or hedge funds who are taking positions in Indian listed companies. The issue that was there for them was really as to what is the characterization of gains which they would derive from sale of shares of an Indian company. Should it be treated as business income or should it be treated as capital gains? So these were two major concerns which were sort of floating around for the last few years. What the budget has really done, or the current Indian budget has done, is given some degree of clarity as far as these aspects are concerned. The first one is as far as the general anti-avoidance rules. What the government has said is that they are going to introduce general anti-avoidance rules from next year. So to that extent, Nishchal's point on the fact that, yes, you need to show certain substance in Mauritius probably continues to hold good. At the same time, India and Mauritius are currently looking at negotiating what you call as limitation of benefits article in the treaty between India and Mauritius, which effectively provides for a certain spending requirement in Mauritius so as to ensure that the company would be entitled to the treaty benefits. So that's something that is actually going on as we speak, and the expectation is that's also going to come into play. If you have the limitation of benefits article coming into play, then the expectation is that the treaty benefits which Mauritius affords will still continue to hold good as long as you meet with the parameters which are there under the limitation of benefits article. So to a large set of investors, especially for somebody who's looking at VC investments or also into portfolio investments, Mauritius still probably continues to hold good. The other two jurisdictions which Nishith pointed out was on Singapore and Netherlands. Singapore, of course, today offers certain degree of exemption as far as the fund regime is concerned, but it comes along with it certain riders. One is from a local Singapore law perspective, which asks that you have 3 people on the ground in Singapore. There's certain spending requirement that is there. Even for you to set up a sub-fund in Singapore, you need to have at least $50 million of corpus in Singapore. In addition to that, the India-Singapore Treaty has an existing limitation of benefits article, which effectively requires you to spend 200,000 Sing dollars in 2 years prior to realization of capital gains. And the other key requirement, which in itself is a general anti-avoidance rule, is that the company should not have been set up for you to take advantage of the capital gains tax benefit under the India-Singapore Treaty. So therefore, in terms of people looking at Singapore as a viable option, probably will work for somebody, a large private equity fund who has the ability to have people on the ground in Singapore, because Singapore is a financial market, and where people do have the ability to have people on ground, Singapore can probably still work as a choice in certain circumstances. Somebody like a VC fund, I wouldn't think Singapore is really a good alternative because of some of the threshold requirements that are there. The third jurisdiction that we are really talking about is Netherlands. Netherlands has been used a lot by hedge funds and other funds which are looking at taking a stake below 10% in Indian companies, especially if they're looking at listed companies, because there they do have the benefit under the India-Netherlands Treaty that under those situations, if they're selling the shares and they hold less than 10%, that would not really be taxed in India. In other situations, there are certain restrictions around Netherlands. So does it work in all situations? Not really. We have seen funds being set up with a co-op structure in Netherlands for investment in India. But again, it's very specific to certain facts that you need to have, because even Netherlands is looking at, has introduced certain anti-abuse provisions. So by and large today, when we look at the Indian fund structuring, Mauritius is still probably the preferred option. Obviously, there are issues surrounding as to how the GAR is probably going to work out. And the second thing is that when we are looking at hedge funds, one of the things that the budget has really done is to clarify that any gains which are realized by a foreign portfolio investor is essentially going to be treated as capital gains. So therefore, to that extent, no one can really take the benefit of saying that, well, my gains are really in the nature of business income, and unless I have a permanent establishment in India, I'm not going to be taxed in India. What the government has said that there have been a lot of judgments on this particular issue. You've had judgments going both ways. But what the government has really said is that at a policy level, we are going to characterize all of the gains as being in the nature of capital gains, which would probably imply that more people will want to use a Mauritius or a Netherlands or Singapore. In terms of even making, even as hedge funds, them making investments in India, because they can't really take the benefit of claiming that their income is business income and it should not be taxable in India. So really, to summarize today, in terms of where we stand, probably Mauritius is still going to be the more preferred destination. There are circumstances where if I do have people on the ground, that I will probably look at Singapore. And Netherlands is really, if I'm looking at something like a hedge fund, I would probably also look at Netherlands as a viable option. The one aspect is that if I'm looking at debt investments, because you did raise the point of people wanting to invest into debt in India, I would probably not look at Mauritius favorably, because Mauritius doesn't have a great treaty with India when it comes to debt, and probably look at a Netherlands or Singapore more favorably, because they do have better rates as compared to Mauritius when it comes to debt investments in India.
Yeah, thank you, Rajesh. Raj, I think I would just turn back to you for a moment. What are the key issues that are being discussed in LPGP negotiations currently? What do you see, any change or anything else? How are they discussing?
Yeah, I think our last discussion was a few years ago, but I don't assume a lot of things have changed. But if there's any change, I think it's more, it's been more in favor of getting more information. I think some of you will talk about the ILPA guidelines, which, some new guidelines have come out which require additional reporting requirements. So I will just touch on 3 or 4 fundamental key issues that always end up in any negotiation. So one is, just to set the context here. So private equity is, the context of 220. So it's typically it's a 2% fees for managing the fund on an annual basis, and 20% carry, which is the profit sharing of 20% once the committed capital is returned. And that's kind of a standard. I mean, it can deviate up or down based on just the demand supply, just like in market forces. But that's normally a typical structure of private equity economics. So the fees are clearly always one of the key negotiating points. And where I've seen is typically, in any fund, typically it tends to be a 10-year fund. 5 years are allocated for deploying the capital and the rest to harvest the capital from the portfolios. So typically there's always a push and pull as to the fees, what happens to fees after 5 years. So that's always a critical point in any negotiation where, a lot of the LPs, they want the fees after the investment program, after the first 5 years, to be really based on the net asset value of the portfolio. So basically, if your portfolio value has gone down, your fees should correlate to that. Or if it's gone up, then it should be lower off. It should not go up more than 2%. So there's always so that's one area. The other key issues, I think Richie mentioned, the alignment of carry and team, because, so private equity, typically they tend to be very small, 4 or 5 member team, and it's very important to make sure the team is incentivized, and, it's a lot of people issues, and it's very much more of a people business as much as it is a finance business. So a lot of focus is given on alignment. The third thing I would say, which is again an interesting issue I've seen, I was not an issue, but it's more in the last 6 or so months, every quarterly when we send a quarterly report to all of LPs, and more recently I've seen that there is more demand from LPs to get more access to information on portfolio companies. Now that's always a very delicate kind of a balancing act, because there's so much information you can provide, but I think there's always a confidentiality kind of breach where you have to manage. So what we have tried to do is, clearly, I think it's good to give more information, but not crossing the bridge. So what we do is typically every year when there's an annual LP meeting, all our LPs from all over the world come to, in our case, come to Mumbai, and we spend a day talking about the fund and all of that. What's really worked out well is in that same session, we invite all of the portfolio company CEOs. And that's gone really well because, once there's a direct, it's not, so they are not just hearing it from the fund manager, but they have direct access to the portfolio CEOs. And I think that's one best practice I feel that's helped us a lot. And it's actually helped the portfolio companies as well because I know at least of 2 instances where 2 of our LPs were able to introduce some direct business development relationship directly to our portfolio. So I think these are 3 or 4 areas where, these are pretty standard. I don't think they're new, but there'll always be push and pull along these lines. So.
Richie, do you want to add something on the LPGP negotiations? You've been experiencing some,
Yeah, I think as Raj mentioned, pretty much the 220 has remained intact. But what has not remained intact, and the reasons are quite evident. So in 2009, institutional LP associations came out with version 1 on the standards. Pretty much 2010 was a year to take feedback from the GP and LP community, primarily the LP community, and 2011 is when the version 2 come out. So pretty much, for an LP to insist on ILPA standards being met by a GP, they don't have to be that institutional anymore. Pretty much, any large ticket investor who knows that, okay, who the GP is, pretty much takes it that, okay, let's meet the ILPA standards on point A, point B. I think one of the aspects where we have spent a lot of time on the side letters has been on the MFN clause, most favored nation. So one LP would insist that, okay, I have an MFN, and if you are giving certain rights on the economic side to any other LP, the same passes on to me. Sometimes, we have to evolve certain, conditions or some arrangements so that we can defend that a particular, provision is there which may not be covered under the MFN clause. So the coverage of MFN clause becomes very critical, especially, in funds where you have a lot of institutional LPs, etc. A couple of years back, in 2011-12, we closed Aeon. This was a joint venture fund between ICICI Venture and Apollo. That was a $850 million fund. So there we had a lot of, learnings on the MFN provisions. The second aspect, which Raj also brought out was post-commitment period. What should be the base of your management fees? So as ILPA, indicates, and that's pretty much what the standard is heading towards, that post your commitment period, the management fees has to be based on either the lower of the costs or the, fair market value of the underlying assets. Obviously has to be lower. Even if your portfolio has done good, you still can't, enhance the base on which you compute your fees. Other, structures and terms that we have seen has frankly been the sign of times, right? So GPs are clearly struggling for India-focused funds to close a blind pool sort of a format. So what they have been doing is separately managed accounts, club structures, etc. So interesting learnings from a club structure would be like, okay, so the GP has sort of, visibility on a particular deal, and the LP bandwidth or the investment bandwidth is about 20 to 30 million. So he approaches a couple of LPs who, sign the checks for that particular deal. Now here, clearly the GP is not operating on a blind pool basis because the visibility on the asset is already there. So what is 2 and what is 20, and whether it is a discretionary management product, or is it more like, IB side product? All these questions then tend to come up. And again, how you design your fund terms, so to speak, around the, the club structure can get very interesting. The last piece which I want to sort of discuss, is, observations by the securities regulator in India and SEBI. What they now insist on that there should be an illustrative model of your charges and fees that you as manager are levying on the fund, as well as your distribution waterfall. Now, if you are giving an illustration, into the fund documents itself, there is very less scope for you to take a view as a GP. So pretty much you have to put a lot of focus and attention on how you're drafting your waterfall and your fund terms, because during the entire tenure of the fund, your ability to, take a view later on is next to zero. So, clearly regulators across the jurisdictions, starting with SEC's director, who clearly, a couple of months back made, past observations that, okay, there is a difference between what the GP thinks the LP know and what the LP actually knows. So clearly, all the securities regulators are heading towards that.
Richie, would you just tell a little bit about the portfolio investment? I think that piece we missed out a little bit. So can you,
Sure. So I think portfolio investment routes is meant more for, players who have short tenure or, pretty much like hedge fund players, etc., What has happened is pretty much when you were looking at the portfolio investments in India, you had an FII regime, foreign institutional investor, meant more for regulated fund managers, advisors. You had a sub-account, which is the fund vehicle which invests into India. They were sponsored by the FII, so there was a FII sub-account agreement which existed. And third was the recently introduced Qualified Foreign Investors Regime, QFI regime, which allowed family offices, foreign individuals, etc. to invest into India. Now, what had happened was there were difference in KYC standards that different funds or investment vehicles had to meet. A sovereign fund or a government-sponsored fund vis-a-vis a broad-based fund structure, vis-a-vis a individual, had different KYC standards. So basically to harmonize these different KYC standards and to basically streamline a one common route for all foreign portfolio investors, apart from some exceptions for non-resident investors, etc., SEBI, the securities regulator, introduced foreign portfolio investors regime, which went live in June this year. What it essentially means is, as a broad-based fund, you can pretty much access investments into India, just like your previous structure under the FI regime. The key difference, however, is that instead of being registered directly with the regulator, SEBI, you will be onboarded by a custodian or a designated depository participant who would be the licensing agent between you and the regulator and would be in charge of your reportings to the regulator to that extent. Key terminologies like, what is broad-based fund? There is a formula of look-through applied of 2049. There should be at least 20 investors with none holding more than 49% interest in the fund. Those standards still continue to apply. There has been slight tweaking. Even if you have institutional investors into your fund, you still need to meet broad-based criteria. And just to finish the loop on portfolio investments, another segment which is of great interest to foreign investors has been that of P-notes or participatory notes, which is a format of offshore derivative instruments, ODIs. These are pretty much ISDA-based contract notes where there is a reference to underlying Indian assets. The assets has to be a security. There's a definition for it, and the security has to be either listed or capable of being listed. So the underlying security could be mutual fund units, listed NCDs, shares of companies listed on the Bombay Stock Exchange or National Stock Exchange, etc. All these can be held by an FII or a foreign portfolio investor now. That FPI can give a back-to-back contract note, which is based on ISDA, to a foreign participant, which pretty much allows the P-note holder to have access to Indian markets without actually owning those shares directly. The regime pretty much remains the same. The only difference has been that you need to be a regulated entity now onwards to hold a P-note. So pretty much this comes as a dampener to those who took exposure despite not being a regulated entity themselves. So there are structures around it. There are issues around NRI participation, but again, there are structures developed around it. But that's pretty much where the portfolio investments regime today stands.
So as I mentioned earlier, I think we have to move on to questions and answers because we have 10 minutes left now. But before I do that, there is a plastic laminated sheet in which, in short, entire structuring of funds has been explained, and you can tag it on your desk. So on one side, it's on structures, and the other side, there's a kind of a description of different jurisdictions, Singapore, Luxembourg, impact of GAR, Mauritius, Netherlands, holding company structures and all that. So this would be hopefully somewhat useful to you. So you can, and it's very difficult to destroy this, you can't tear off, so it will stay with you. Just, okay. Okay. And there is also that book, Fund Structuring and Operations, etc. That should be really helpful. Let's now open up to the audience here first, and then if you have extra time, we'll have people on phone to ask questions or discuss or debate or questions. Yes, please. Thank you, Sridhar.
Yeah, associated with a fund administrator, not fund. So I must say, with all due respects to all the panelists after the Nishith, the last 40 minutes from a private investor's point of view has been very confusing. Because I invested private equity in the US for many years. I never had such a confusing web of rules and regulations and environment, etc. When can I invest in an India fund which is India-centered, forgetting Mauritius, forgetting Netherlands, forgetting Singapore? There is no point of reinventing a structure for private equity fund. It's been existing for ages. Well, India has been attacking private equity fund only since 2005. I'll summarize the question for you. Does India need foreign direct investment to private equity investment, or is the priority that for the government of India to tax those investments in India with the interest of taxing the investor? Where is the priority? Is the priority attracting foreign direct investment and considering the GDP go to these investments, or the priority for taxing those funds that I have recently, some of the funds which charge 5%, 10%, getting absolutely confused. And honestly speaking, absolutely confused. And believe me, I'm an investor. I have investable funds. And I'm sure there's thousands like me in the United States. But it is absolutely confusing web of regulations.
Absolutely. I think you said it right, because when government talks of foreign direct investment, it encourages foreign indirect investment through Mauritius or anything like that. I think ideally, if we can have a regime that can get rid of all those kind of stuff, that would be very good. But in simple words, today, if you are investing less than 10%, the regime is simple, number one. Long-term capital gains are tax exempt. Okay, that's as simple as that. So in many cases, you may not, as an individual, you may not have to worry too much. If you are having short term, then it's slightly different issue. But when you're having collective investment pool and private equity stuff, then it gets a little more complicated. So, well, I think government is very kind to the legal community to keep this, us in the business. Because if they become too simple, of course, we still have about 100 years of work in front of us. So we're not too much insecure, but for the next generation, government is creating all this and the litigation system, which we'll talk about later on. But I fully agree with you. I think we can still simplify the whole process. But lately, there has been some simplification. If Richie or somebody else can talk about it.
So
Quickly.
I think the simplifications have been at two levels. One on the regulatory front. Clearly, there were a lot of, under construction projects is what you could invest. Now with the opening of REIT, and maybe Nishchal can add to it, there is some amount of, bandwidth being created for ready projects. So there is a regime being created for exits also. Same in case of infrastructure. Earlier you had infrastructure debt funds, which was more under construction infra projects. Now with infrastructure investment trusts, you have ready infrastructure also moving in. So on the regulatory front, government has clearly been taking note. On the tax front also, the government came out with an agenda, that, okay, let's straighten out the taxes, no more look backs, etc. There are compelling reasons even for the government to augment the revenue. They clearly see collection of taxes to be one of them. These are conflicting times. Clearly, there is a conflict between augmenting the foreign investments into the country vis-a-vis, revenue augmentation. So maybe, Nishchal, you can perhaps add from a REIT perspective.
No, I think more than the REIT, I think it's a long subject. Maybe we can cover later. But I think on the simplification, the government has made it very clear that their intent is to simplify the tax regime in India and to reduce the tax uncertainty. So in fact, even the previous government was going to come out with a direct tax code, which was going to overhaul the current Income Tax Act in India. And interestingly, currently, we have about 8 to 10 tax rates just for long-term capital gains and short-term capital gains, depending on whether the shares are listed, whether you sell it on the floor, off the floor, whether the shares are unlisted. So you're right, a lot of complications under the current regime, but what the government has promised is that, and that was also one of the agendas in their manifesto when they were campaigning for the elections, that they want to ensure that there is maximum certainty when any investor invests in India. And second is they want to simplify the tax regime. So maybe I think budget 2015 would be a good benchmark to decide whether the government has delivered on its agenda of simplifying the tax regime or not. But clearly the intent is to move towards a simplified regime.
Yeah. Any other comment or question? Sorry. Please state your name and,
My name is Vinita Mehra. I'm from the law firm of Kegler Brown. I have a tax question. One of the key issues that come up is on the substance with respect to using different jurisdictions like Netherlands, Mauritius, and we have a couple of clients who have small funds. So in that scenario, creating substance or being able to prove to the Indian tax authorities that substance is something that we need to worry about very early on in the fund formation rather than later when you're bringing the money back. So can you talk a little bit more about what has been recent case laws or what has been the understanding of the tax authorities of proving substance when you use different jurisdictions? Thank you.
Sure.
And here, I think you have to look at it from two perspectives, right? One is that the
Can you
world...
get your mic closer a little bit?
Yeah.
Pull it up.
You have to look at it, the world before GAR comes into place and the world after GAR comes into place. So as far as the world before GAR is concerned, I think today, as the law is pretty clear on the subject. The law says that if you're coming in through Mauritius, if you have a tax residency certificate, then India is not going to look through and go beyond it. Having said that, there are enough case laws that are there. Tax authorities do not always respect the circular that has been issued by the CBDT, the Central Board of Direct Taxes. But yeah, the courts do appreciate it. So yes, you will have litigation. Unfortunately, that's not something I can tell you that you're not going to have litigation. But the courts are very clear on the subject. Looking at the world post-GAR, where there is a requirement today as to is there a commercial substance behind, let's say, a Mauritius company or not. If you're looking at small funds or small VC funds, a setup in Singapore is not always possible. You will not meet the requirements which are there under 13R and 13X of the Singapore, the MAS exemptions. So looking at the Singapore platform is usually going to be tough. Netherlands has got its own anti-abuse rules. And again, you do have certain restrictions around what is the quantum of investment that you're holding, who you're selling it to for the treaty benefits to really apply. So you're really down to Mauritius in a lot of senses. And that's where the question of what is the substance that's required becomes important. And here, what you need to keep in mind is this. India and Mauritius, they are going to have a LOB that's going to be there in place. If the LOB is going to be restricted to a spending requirement in Mauritius of, let's say, USD $100,000 or less, $75,000 is the number that's being talked about right now. If you're there, then that's a bright line test. So you're either within that or you're outside that. If you've spent less than $75,000, let's say, if a LOB comes into place, then obviously tax authorities are going to go into the substance. And substance can be in many forms. Substance can be from the fact that, yes, I have people in Mauritius. Substance can be from the fact as to there was a commercial rationale for the structure to come into place. One of the things I keep talking about is that, well, if I have US investors or if I have investors who are pulled in Cayman, they may not necessarily enjoy a bilateral investment protection agreement. If I have a Mauritian investor who's coming in, they can actually enjoy it. To my mind, a capital protection is a good enough substance for me to actually have a vehicle in Mauritius. Having a vehicle as a pooling entity is, again, another commercial requirement. But the key element here is that these cannot be post facto actions. These have to be prior to the structure coming into place. You actually have to have all of these documented. You cannot 5 years down the line when your case is picked up for scrutiny by the tax authorities, try and create documents. These are acts that probably happen beforehand. And any time when we are looking at a structure, there is actually a commercial rationale. The question is, have you documented it in the right manner so as to bring through the substance at a later point in time when the questions actually get raised? I think that becomes the critical aspect. And as I said, if you do have a LOB that comes into place with a $75,000 spending requirement, that's a bright line test with which you can just go through.
Yeah, thanks a lot. I think it's almost 2:50, so we have to get... Can we take this little later? Because 2:50, second panel, we want to... But we'll make sure we reply your question.
And any questions can probably be offline.
Yeah, so because next panel, the time starts at 2:50, so may I have a great round of applause for my colleagues. Thanks a lot. Very good.